everyone. We're delighted to have you here. I'm going to wait for my two fellow panelists to join here. Excellent. Thank you so much. Thanks for joining us on what I know is a suboptimal way to be together. We all miss each other. We'd all like to be in the same room, but I'm really grateful to Global Washington for making this happen and for bringing us together here. The topic of today's panel, is billed as savings and savings for the poor. And it's really about this broader question of resilience and how do we help our most vulnerable citizens and population. And we have an amazing panel here to talk about those questions. The question of savings has been around for decades. When I first started in this field working in microfinance, there was a lot of chatter about why are we giving loans, when actually a savings account can be a much more powerful tool for the poor to be able to withstand shocks and to get out of poverty. And for a lot of reasons that we won't go into in this panel, it was easier to build a business by offering a loan and getting, around regulations by lending money to people. And so microfinance took off as a lending activity with some savings components. But what we want to explore in this panel is especially what we've learned in COVID about how savings can really be a lifeline for the poor and room for improvement in the way we're offering it. A little bit of housekeeping before we get going. We are going to kick things off with some questions that we as a panel have talked about in advance. And I'm going to invite my fellow panelists to keep things lively. Feel free to disagree with each other. I think that might happen from time to time. And feel free to comment on each other's remarks. But I also promise we're going to leave time at the end because we know the Global Washington community is filled with practitioners who have your own experiences. We'd love to hear your questions. We'd love to hear your comments. And you can put them in the Whova app, and I'm going to be monitoring that, and we'll bring it back to that. And then last bit of housekeeping, I should say that I'm going to be doing double duty here. I am both going to be moderating, and I'll also be sharing the experiences of the perspective of my organization, Upaya Social Ventures. So with that as an introduction, I'd like to kick off the panel. And instead of reading the long and impressive biographies of our panelists, what we decided to do instead is to invite the panelists to introduce themselves and their organizations by explaining how their work intersects with this question of resilience and savings and the programs that they're seeing, either on the ground or through policy level, or in my case as an investor. So let me start with Alberto Solano, who is the President and Executive Director of Agros International, and I'll let you take it from here.
Thank you, Kate. Thank you all for joining. Saludos from Nicaragua. I'm right now in Managua, so I hope that the signal is good and you can hear me well. It's been a little in and out over the day. As Kate said, I'm Alberto Solano, the president of Agros International. We're a Seattle-based nonprofit working in Central America and currently working with a lot of indigenous communities in the highlands of Guatemala and Nicaragua. Some of these communities impacted by chronic child malnutrition, so among the poorest of the poor. And despite all these difficulties, we have seen very positive progress, early progress, but positive, around savings and productive initiatives, even in these very vulnerable sectors, even with COVID and all the situation that we've been going through over these last couple of years. So thank you for having me, Kate.
Thank you, Alberto. And now I'd like to introduce Sevilla from the Bill and Melinda Gates Foundation.
Good morning from Seattle. It's an honor to be with you, distinguished panelists and guests, really to discuss the importance of savings in the context of inclusive growth and innovation. As Kate has mentioned, my name is Sevilla. I'm a senior program officer with the Bill and Melinda Gates Foundation. I work within the Gender Equality Division, where I lead the division's work on a sub-initiative strategy focused on women's empowerment collectives to advance women's economic opportunities and empowerment outcomes. I've worked in the savings group sector for the past 2 decades, managing multi-country programs, leading technical alliances with financial institutions, formal financial institutions, telcos, fintechs, really driving financial inclusion for women who are found in these savings groups and really helping them to access formal financial products and services ranging from savings to insurance. It really is an honor to be here with you today, and I look forward to speaking with you all about the Foundation's work around savings. Thank you.
Thank you, Sevilla. And just to introduce myself and my perspective on this panel, I'm the CEO of Upaya Social Ventures. We're a nonprofit organization that makes investments in for-profit companies in India for the purpose of creating jobs for the poorest of the poor. I'll be talking a bit about some of the research that we did throughout COVID that was a bit eye-opening for us in terms of savings and the realities on the ground. But speaking of on the ground, Alberto, I'd love to hear your perspective about the work you're doing and how you're focusing on savings and community engagement.
Thank you, Kate. Well, I just spent a couple of weeks in visiting families in Central America and thinking about this panel. And I was talking to them and asking them what kind of debt they have. And I was actually a little concerned, surprised about the answer. So I'm going to start this with actually the debt side, not the savings side, Kate, because I was shocked by the responses. Usually you will think that families in the highlands, families in rural areas will either have no access to credit or savings, which is kind of the most, but when they have is some of the worst type. And over the years, it was loan shark, middlemen, the ones who were taking over this kind of most difficult debt. Today, what we're looking is retail stores. And I was shocked to see how many very poor families are completely over-indebted by the ease of access of merchandise and consumer goods at retail stores. From, that refrigerator you wanted to this small bicycle that you need to move, everything now is easy. It's easy to get. And while in the industry, and you mentioned, Kate, that the industry went, the microfinance industry got formalized, and those of us who have been doing microfinance for a long time will remember that years ago, multilateral banks, big bilateral organizations pushed for specialization. They tried to separate, and they did separate, financial services from business development services in order to formalize entities and get regulated. And there's a lot of benefits of doing that. But the unintended consequence was that all this business development, financial literacy, those hand-holding services for the poor became just a box to be checked or disappear or turn to be delivering the minimum expression. So yes, credit has increased, but not the capacities of the families at the same time. And as organizations regulated and get formal, they move up their segments, leaving the poorest people actually exposed more to the traditional loan shark, or now these retail stores that have extremely hard interest rates, but sell you a dream of a $3 a week easy installment to get whatever you need at home. So I think it's surprising to look at how debt has changed in rural areas. It's not longer debt for an illness, although that happens. Is not longer debt because a crop went bad, but a lot because consumer goods and consumer retailers are actually penetrating the household finances. And that's something that I think also the sector have to be more aware, because they're definitely learning or have learned how to better communicate, how to better reach, how to better sell, and how to use behavioral economics in their work, while we have learned very little about those in promoting savings.
Thank you, Alberto. I think that's a fascinating point, and especially I think you and I have been in this industry for a long time, and know that 20 years ago I was talking about the unbanked and trying to connect people to the formal economy. And what I'm hearing is that original dream of connecting to credit for productive uses, which has both pros and cons itself, has now been sort of subverted, or at least has come side by side with consumer debt, which can be devastating to a poor family if there isn't the income to sustain it. And in some ways, savings is the flip side of that kind of a product. And we'll come back to programs that you're running to try to encourage savings. I know that Dean Carlin has done a lot of research on this, of demonstrating ways that the poor can save, but that as an industry, I think we need to do a better job of picking up those recommendations. Sevilla, you have been doing work at the Bill and Melinda Gates Foundation on policy level and working with governments. Can you say more about how you are looking at these issues?
Yes, thank you, Kate. And really just want to say thank you to Alberto for raising the point on consumerism and consumption, taking credit for consumptive purposes and not really for productive purposes, and kind of tracing that root of not having those hand-holding services that the poor, especially women, need as they are venturing on to livelihood opportunities and investing in productive ways to expand, grow, diversify their livelihood opportunities. And I really think what you've painted is something that we're seeing in South Asia as well, in India, where debt is rising. And it's scary. It really is something that we need to take caution around as we build out stronger services and products for the poor, but also get them really engaging in the ecosystem of financial services, which they need in order to build out more resilient livelihoods and be able to diversify and expand and contribute to the economy. So I think first it's important for me to give a bit of context and history of the foundation's work in the space of women's economic empowerment. So in 2018, the Bill and Melinda Gates Foundation launched its first gender equality strategy with women's economic empowerment at the center of the division's theory of change. And this vision really is underpinned by the belief that gender intentional programming and the opportunity to participate in, to contribute to, and benefit from economic growth are essential for women to gain access to income and assets and control and benefit from economic gain, and really have the power to make decisions. And this, of course, aligns with a number of SDGs, specifically the ones that our session is speaking to, but most particularly with SDG 5, which aims to achieve gender equality and empower all women and girls. So since we launched the gender equality work, we've been raised to a division at the foundation, and we've just actually celebrated our first year of operation. And recognizing the critical role that women can play in economic growth, the foundation supports key priority areas to close the gender gap, which encompasses the gender equalities division's women economic empowerment 3-pillar strategy, if I can call it that, which we focus on gender data and evidence. We focus secondly on women's livelihood development, and then thirdly on policy and advocacy. Now, for gender data and evidence, our work focuses partly on identifying and diagnosing gaps in gender data production and financing and analysis to address constraints and target efforts. We promote a supportive policy environment to address institutional and financial constraints and to strengthen policies and practices governing the production and use of gender statistics. We also generate higher quality evidence on what works for women's economic empowerment, specifically focusing on East Africa, but we aim to disseminate it broadly for uptake and scale, and building really a stronger evaluation field as well for women's economic empowerment in Kenya. As you just mentioned, IPA is a strong partner who has brought up a lot of that evidence to date that we all use, and we're looking to build out stronger networks of Kenyan institutions that actually can bring up even more nuanced data. Now, for women's livelihood development, we engage to support the expansion and growth of women's livelihood activities by strengthening their access to productive resources. So sort of what Alberto just raised in terms of the hand-holding services, the BDS that we know that once dominated part of the microfinance equation. And really looking at market opportunities in labor as well as enterprise. You know, the economies are changing around the world, across Africa. We are seeing industrialization, we're seeing gig work, we're seeing e-commerce. So there is a lot of labor opportunities as well as micro, small, medium, of course, enterprise opportunities. And really, we're aiming to unlock income generating pathways. So not allowing women to just focus on the traditional livelihood opportunities that they have, for normative reasons, have been forced to maintain, but looking at what are some of the pathways that they can go into that really are fostering greater incomes, and really looking at overall economic empowerment. So our strategy to date for advancing women's economic empowerment has been focused on driving these women's empowerment collectives, or what we call WECs, in Africa as well as in India. Right now, we're in the midst of reorienting our strategic focus for women's economic empowerment, ensuring that there are decent and more income earning, productive resources really going into the hands of women so that they build more resilient pathways to economic empowerment. But to date, we've really focused our efforts to scale and infuse quality within these women empowerment collectives by fostering partnerships to support governments in establishing and strengthening the effectiveness of women's groups as platforms for really onboarding women and aggregating the delivery of financial services and products, really aggregating and delivering market access opportunities and efforts to really dismantle social norms that impede women's economic participation. Now, WECs is this new term that something that we use to define the groups that women around the world join to provide economic, financial, and social supports to one another. But in essence, it implies a concerted effort to include key elements as they relate to women's economic empowerment, and specifically aimed at building women's human, financial, and social capital. And this concerted effort to sort of link and layer onto these groups is what the foundation believes is necessary to drive a more holistic approach to attaining women's economic empowerment, and really broken down embodies 5 key elements. First is this pooled savings and shared risks, where groups take decisions on their own terms and they determine who to support within the group and how, and creating this informal safety net. And then second, group solidarity and networks. And really this is to build trust and social cohesion through norms of reciprocity, rule adherence, reliable repayment, and collective decision-making. The third is really looking at participatory learning and life skills, this hand-holding again, to learn about financial literacy, health practices and services, as well as how to problem solve collectively on business efficiency, productivity, and profitability. And then fourth is looking at critical consciousness of gender. And this element really entails empowering women with a sense of personhood by discussing rights, inequality, and norms, and to identify and advocate for their own needs and take collective action to problem solve, increase decision-making, negotiating, control over finances, and even family size. And this is done through dialogue, role modeling, best practice sharing. And this last element, access to markets and services, which essentially focuses on reducing transaction costs for members to participate in market activity, And it also implies linking to local government and service providers, accessing government benefit schemes and commodities. And really, evidence has shown that by adding these 5 critical elements to existing or new groups, you effectively create a comprehensive and cost-effective model that can deliver critical economic and social benefits to women. So across the strategic area, we're supporting innovations, research to deliver and understand critical outcomes and cost effectiveness for layering and linking these platforms to a variety of market actors through what we're calling these WECs. So, I mean, in some, the foundation has pledged, and I could speak a little bit more later on our policy, advocacy, and communications work, but in some, the foundation has pledged to work together with other organizations to achieve these goals by 2030. So far, we've committed $270 million on gender equality, with a further new commitment of $650 million over the next 5 years to strengthen women's economic empowerment by supporting, in part, women's empowerment collectives. I'll pause there.
That's great. And we will definitely come back to what you're learning, especially on that first pillar that you talked about with the WECs as a collective savings vehicle. And I think that, you know, as Alberto was talking about, when microfinance started formalizing and for regulatory reasons dropped savings, there was a call for more nonprofits to step up, create opportunities for these savings groups, very often women-led. And, you know, I think that there's a lot to learn from what you're seeing there. Let me just take a few minutes. I mentioned that Upaya has been doing a lot of research, actually, since we were founded 10 years ago, on the job holders of the companies we invest in. I mentioned that we invest for the purpose of creating jobs for the extreme poor. And so we always do an assessment of every company, whether the people they're employing are actually the poorest of the poor, and whether their income increase is moving them out of poverty, and what are some of the indicators of quality of life. And so we've asked questions about, are you saving? Have you opened a bank account? You know, what assets are you purchasing? And I will, you know, humbly admit that we've felt pretty good about the fact that, you know, even among, you know, this very, you know, relatively poor population, on average, over all of the surveys that we've done for 10 years, we saw that at least half were saving, about 48%, slightly more, 52% had opened a bank account. And so we felt that they were beginning to build that kind of financial foundation and cushion that would enable them to withstand a crisis. Last summer, you know, 3 months into the COVID crisis, we did a specialized survey to learn how they were being affected, and learn some things that were both positive and some things that were more concerning. We were afraid that many of them would be decimated without income. And what we learned is that the enterprises we had invested in, even though they didn't have revenue coming in, most of them were continuing to pay their employees. Which, you know, was gratifying to know. About 76% were continuing to earn money. However, 77% said they had gone through all of their savings. And so what that told us is maybe they were saving, but we weren't asking enough questions. We didn't know how much they were saving because within 3 months it was gone. And so, you know, perhaps there needed to be a more formalized mechanism. And then, you know, just to fast forward a year, this summer we went back to do more surveys to learn how they were doing. And I imagine most people on this call will know that, you know, the second wave of COVID was just devastating in India. And we were, you know, again, worried about the wrong thing. We expected we were going to hear horrible stories of health outcomes. And in fact, we didn't. Most of the job holders we surveyed had not lost people. They were healthy, but they were in debt. There significant rise in debt, just as Alberto mentioned, you know, which we all know is it's a stone around the necks of the poor if they are trying to rise out of poverty. And so it has, this particular topic was very interesting to us to learn more from our panelists, because we think that there is a role for an investor to play and in enterprises in helping their job holders take advantage of some of the recommendations for ways that the poor can get into the habit of savings and build those foundations. So Alberto, I'd like to turn back to you because, you know, we do know it is challenging for the poor to save on a regular basis. And, you know, the financial structures that exist right now are not set up with them in mind. Can you talk about adaptations that your organization has made to encourage savings and, you know, help the individuals withstand the kinds of shocks that we've seen?
Yes, and, you know, in terms of adaptations and research, this hasn't been done much in Latin America, not like Africa or Asia, as Sevilla will point out. I think there's a lot more that in our region has to be done, particularly when you're talking for those off-the-grid savers or people who need access to rural financial services, no? And we just begun, we do it for many years, and we just started again to promote savings among this group of particular women who are affected by chronic child malnutrition. So they're among the poorest of the poor. And one of the guides that we've been using to put to develop our messaging is actually based in some conclusions of a study made in the University of Milan by Anderloni and Bandoni, and they said simple conclusion when they were studying the risk of over-indebtedness and behavioral factors. And they said that us as individuals, we tend to overestimate our capacity to manage our domestic financials. And we tend to underestimate the possibility of being impacted by a negative event. So we think that we're very good with our own household finances, and we think that nothing's going to happen to affect us. That was a big, bold conclusion of that study. And the second related to that is that as individuals, we systematically underestimate the risk of not meeting our financial commitments. And when that happens, we turn out to exogenous factors. Oh, it was the pandemic, it was the lack of job, it was XYZ, rather than thinking about what led us to debt and what were decisions that brought us there. And we've been thinking along those lines in order to deliver the messages to the women we're working with. And let me be clear here, we're making no innovations. We actually are going back to the work that the Gates Foundation funded back in 2014 with the Grameen Foundation in Asia, with Dean Carlin involved, where in those different countries, in Asia and India, they demonstrated that savings to be successful should be made easy. So we're following the same list. For savings to be easy, they have to be in group settings. The groups have to be formed by affinity. We have to build time for social interaction, trust building within those sessions. They have to be periodic, no? Training and entrepreneurship has to happen in those sessions. Savings are not mandatory, totally voluntary. We need to celebrate those who save and those who didn't save. And we don't set any target for savings. Nothing new. This is something that the foundation funded years ago, Grameen, Dean Carlin validated in other continents, and still valid today in the highlands of Guatemala. But what we've been trying to do different is helping women reflect on their decisions. And that's more focusingly on the consequences of borrowing, on the consequences of saving. So we engage in simple dialogues around, remember what episodes of their life were hard. And the fact that they didn't have money to resolve will make it worse or make it easier. And trying to decide what could have been the opposite, what would have been the alternative. Now, reflect on what it would have done if they would have had that saving aside in order to address. So if we go back to the study of the University of Milan, that we tend to underestimate negative effects and to overestimate our capacities of manage our financials. And we build into the curriculum, same that has been for decades. but build the spaces of reflection, of introspection when those negative impacts have occurred. And when those overestimations of our fortune, actually we did as well, we start to create more conscience among women. And again, without even talking about goals, you know, in this very short period of time, I'm happy to report that, you know, women's in credit groups are saving about 13% of the portfolio. That's about $10.5 per person per month, which if you add it onto an annual basis, it's more than a month of a day labor, or a month of somebody who will be hired as a maid or in a entry-level employment. So they're saving the equivalent of 30 days. And when we go to groups that are not credit-led, but just savings associations, they're saving a third of that, about $3.5 a day. So between $35 to $45 a year. So what we're starting to validate here is that there's a lot, we have to use technology, and we have to use a lot of more tools, but we need more research. We're applying same learnings of the past and are still applicable today. And if we focus on those behaviors that we want to embrace and those behaviors that we want to avoid, as retailers are doing to create more consumer debt, it's a whole new field that we have done not enough. And just to finish, just one comment, which I would love Civil to mention. We work with families. In these rural areas, when we work and when we go and talk about women empowerment, women entrepreneurship, you know, 80 women come, 5 come back. That's a natural barrier for in these very rural societies. We have to focus on talking about family. The family here, the men, the role of the men. Our message centers around the family and the contributions of both, and invite the men to actually be part of this process. Work with the community leaders to be part of this process. Because if not, we're having a lot of barriers, a lot of fears, and these women-led groups, which are totally the right way to go, have a lot of entry barriers in these very, very traditional rural societies. So I would love to, if I can, I'm sorry, I'm intersecting here, would love to hear the perspective from Civil about that, if I may.
Please.
Excellent. I mean, all the points that you've raised, Alberto, I think merits a session on its own. Let me start with the barriers, which, you know, on our end, the way we're looking at that, or the work with families, as you've mentioned, the way that we are looking at that is more on the normative side. And the way that we work with women is actually by working with the community, because in the African context, in the Indian context, there are a lot of norms that dictate how a woman is supposed to act, what type of engagement she's allowed to have in terms of her livelihood activities, as well as decisions that she's allowed to make in terms of spending money, household related finances, as well as education of the children. So the work that we do strongly looks at how we can further women's economic participation, as well as decrease gender-based violence, so that women can actually have the opportunity to engage economically. So we engage with partners like Tostan in Nigeria, for example, where we build social capital and address adverse gender norms to more effectively pursue this goal of strengthening women's economic empowerment. So really looking at how do we work with communities, the local leaders, the duty bearers, the decision makers that are spouses, that are uncles, that are the males in the communities. How do we work with them? How do we ensure that they become champions? They understand fundamentally the role that women can play in helping to advance their local economy as well as the national economy, and how they can see women as humans, and how there could be a dignity that's brought back into communities, and looking at how empowering women as equals will allow for a lot of advances in the community to take root and go forward. And of course, I can tell you lots of stories of Tostan's work across the African continent in eliminating female genital cutting, and introducing early childhood education. But also there's a number of community projects that Tostan's work has been able to get communities to envision together in a collective manner, and really at the leadership of women. So really putting women in a position to discuss and define their vision for the future for their community, allowing them to stand up, and allowing them, saying, all members of the community are really seeing women as equal actors, equal visionaries in how their community can move forward. So it's not just a household approach, because we recognize that when a woman leaves her house, be it for a livelihood activity, be it to collect water, be it to go to a market, she has to engage with a community. So her spouse, her household may see her as a dignified human being that can interact in whatever she sees agency to interact with. But if the community doesn't see that, she will still face those barriers the minute she steps out of her door frame. So this is why we focus on the community and not just the household. I think there is a lot of work that has to start at the household, because then that spouse can also be a champion to other spouses in the community, but it has to be done in concert and in synergy with the community. And just highlighting the Tostan's work is definitely one where we help communities align with their fundamental values, reflect on them from a religious standpoint of view, but also from a human rights standpoint of view. So this one definitely merits a whole session. But in addition, I think you brought up, this aspect of shocks, and where we see women have and poor communities just have this particular vulnerability to shocks. And if I can speak from the African context, and yes, I'm speaking about a whole continent of 55 countries, but from that context, from that point of view, I think we have to remember that, yes, COVID was one of the shocks, but over the past 2 years, and within a year, you have a flood, then you have a drought, then you have a locust invasion, and then you have COVID, and then you have an economic lockdown. So that's like 5 different shocks that these vulnerable communities have had to face. So when we talk about depletion of savings, it's 100% normal, because they were still using their savings from the drought issues that were brought up. So we have to figure out how we can really build up that resiliency in a continuous fashion, and do it in a manner that is complementary with a lot of social welfare programs. And we know that a lot of governments don't have the capacity to take that on in a continuous manner, given all the natural disasters I just listed, plus this global pandemic that has come on board, which has caused economic repercussions. But I do want to flag that multiple shocks hit these communities much harder and in different ways and throughout 1 year. So while we're kind of dealing with COVID and thinking about COVID as a priority in our lives, they're thinking about the locust, the flood, the drought, etc. And I really value your points around, at least this is what I heard, but I really value the points around learning from Latin America and South Asia in terms of the debt crisis that has unfolded. And I think as we're looking at engaging better with market actors across various geographies in Africa, and really stimulating an ecosystem of actors so that it's not just the government's responsibility, it's not just a public sector responsibility, but we're looking at how we can create more vibrancy in the private sector, I think it's up to us to take the lessons from Latin America and South Asia and ensure that we're not saying that credit is the answer. It's a variety of products that we have to think about, which include those very much those hand holding services, those coaching services, those mentoring services that will help women to really build and expand their livelihoods, or engage in employment opportunities in a dignified and a meaningful way that generates income. And there's a variety of things that are happening across the African continent that is producing new ways of thinking. So I really think that there's a lot of space for innovation in this area, but we have to be cognizant of what has been learned, or the lessons that are coming out from Latin America and South Asia in terms of debt and credit. We have to be careful about that.
Absolutely. And I'd like to take this back to what you were talking about with the WECs, and connect it to Alberto's comments, which I also want to come back to in just a minute. I'm really struck by the increased success in savings groups that are voluntary, that are norm-based as opposed to rule-based. And I'm curious if that is the same approach that you are seeing in Africa, in Asia. Are these women's economic collectives? I'm trying to make sure I have the words right. Are these savings groups defined by the rules made by the women? And are they voluntary? Are they having the same kind of success? Or because it's such a broad geographic spread, and I'm sure there are lots of other elements of diversity, is it too hard to say, oh, this is what works?
Yeah, well, the dominant type of empowerment collectives that we work with at the base are savings groups, right? So you have your VSLA, the Village Savings and Loans Association model by CARE. You have the Silk groups by CRS. And the traditional tontines, the susus, chamas, depending which country you're in, there's a different name for it, right? And at the base, it is self-selected. Everything that Alberto said, self-selected group of women, 15 to 30, come together, and then they define their rules. They define their governing board, so the chairperson, secretary, treasurer, money counters, and they're the ones who define how much they save on a weekly basis. Of course, the model has advanced, and it has a share system, which allows for flexibility. So this week, I'm able to contribute one share. One share in my group is equivalent to 10 cents. In another group, it may be 25 cents. And this week, I'm able to contribute 5 shares. And since my share in this group is equivalent to 10 cents, that means I'm saving 50 cents this week. Next week, I've invested more of my money in my livelihood, or there is a bill to pay, so I can only contribute 2 shares. So it allows for a woman to be flexible. And I think, Alberto mentioned the point of not everyone has to save. In the African context, everybody has to save, but not everybody has to take credit. And that, I think, is a beautiful concept, because not everybody needs credit, right? Not everybody has a productive use. And within these groups, they have loan decision meetings once a month. Not only is loan repaid, and at most meetings, most groups formulate the rule where you just have to pay the interest on a monthly basis, and then you could pay the principal in a lump sum at the end of the loan term. But at these meetings, women go around in their circle. First of all, they sit in a circle, the box is in the middle. So everyone sees every single transaction. So there's transparency, there's accountability, that so-and-so said they brought 2 shares, they brought in 20 cents, and I see that 20 cents was put into the box. But during this loan meeting, you actually have the women raise their hand and say, I need a loan to start, a piggery business, and I want to, take out 20,000 Ugandan shillings, and then buy 2 pigs. And they go around and listen to everyone's request. And it's that trust. It's the fact that they live close together. They know each other. they know so-and-so is actually going to invest it in pigs. They know so-and-so isn't going to, or their husband or someone isn't going to actually take that money and divert it into something else. So I think this is a very important, the solidarity aspect is a very important piece, because we know we've built so many sophisticated algorithms in order to determine credit worthiness, in order to determine whether you can take out a loan and repay a loan. And this one is built on a system of community and trust. So there's definitely basic principles within the model, which are pretty universal across the African continent.
Great, thank you. Yeah, I'm struck listening to you by this, notion. Like 20 years ago, we were talking about formal inclusion in the financial sector, and we want banks to open up savings accounts, and we want them to offer loans, and there is still this core value in social collateral, in trusting your community, and so there's some things that I think are just so fundamental. But Alberto, I want to come back to you because I'm really interested in your point is a really good one. We need to understand the behavioral economics better to be able to encourage savings. But I'd love to hear if you have any sort of hypotheses about why the one voluntary group is saving so much more than the mandatory. And you sort of touched on it, but I'd love to ask you to go a little deeper on what you think the psychology is there.
Well, okay, by no means I'm a behavioral economist, so, but what I can share with you in a very uneducated way is that it's all about those basic principles that Sevilla and you remark. All the methodology that Sevilla just described of women raising hand to take loans and meeting together and having the box in the middle, that repeats in Honduras, in Guatemala, in any of the areas with women who don't speak Spanish, just Mayan languages. And the glue that put us together, the trust that they build with them. The mandatory part of that is kind of breaking the trust, in my opinion. Let them feel comfortable, let them, find in that group, that cohort of friends and supporters where they can feel really united, and they will continue and embrace methodologies and change. Once they start to share their dreams and what they want to do for themselves, everybody just starts to build on top of those. And yes, savings for us are not mandatory, but 98 or 100% in other methodologies of the women are saving. So it's the vast majority. Yeah. And as we evolve in the process, I'm sure that will move into a more goal setting. But I think on the behavioral part, it's about always making the message positive. It's about repeating that message continuously. And it's about linking back that message to the 2, 3, 1 thing that inspires these groups to move forward. And I believe as well that we have a lot of work to do on how to actively engage men into this process. A lot of the savings that happen outside of these savings groups are savings that are done hidden, are done by fear, and are hidden. And understanding those behaviors will help us move these methodologies forward. When you talk to these women, how they save when they don't have these groups, they make up stories. They go to the market and buy a cheaper food staple just to get a couple of quetzales saved. They buy less of something so they can save a little bit hidden, and they don't talk about it because of fear. Men want to pay for the next crop, the next tool for the land. Women want to have other very different interests, health, education, clothing. So if we understand what are the entry barriers, like fear, like male active and positive participation as the engagement of these leader community groups that Cyril so well mentioned, if we learn more of that in our local context in Latin America, I think from there, the behavioral economics part of the product design will occur. But sadly, Kate, I'm referring to studies on consumer, or sorry, on savings behavior that were done in 2013 and 14. That just undermines or puts in evidence the lack of work that has happened, at least in Latin America, for this kind of processes. Let me stop with this. 10 years ago, Uganda was already starting to digitalize their BSLAs. We just started this year in Guatemala and Honduras with the support of the IFAD to digitalize BSLAs. And we're for the first time using tablets to track all the transactions and help women, better manage their groups. But now we're finding structural problems like, the amount of savings that this woman can save in a month is equivalent to the cost of the data. So we have those huge barriers of entry. And I think if we really want to move this forward, we really need to understand and do more research on the barriers of entry and how we can use those behavioral economic theories to move things forward in product design.
Great. Thank you, Alberto. If I can just jump in and say, we're going to move to questions in just a minute. So if you have one that you haven't shared, please do so. I've got one more question that I'm going to ask the candidates, although I'm going to let the candidates, goodness, you can tell I'm a political hack, but that I'm going to ask the panelists. Sevilla, though, I wanted to let you comment on Alberto's remarks.
Yeah, just two remarks, just to make sure that, I'm bringing in this perspective of women's economic empowerment and women's empowerment collectives, and have been speaking about women in groups. But when we look at the East African region, the groups are heterogeneous. We have the majority of groups are 70% women on average and 30% men. So we do have a mixture of individuals in this group, and it's really looking at, again, at this community question. So when they're looking at forming their groups and self-selecting, they're actually picking members of their community to which they have affinity to. So it could be male or female. In the West African context, you find the majority of groups tend to be like 98, 99, 100% female. So there is a difference across the continent in terms of the composition of membership. And then the other part that you brought up in terms of digitization, not only for financial linkages, but digitization for market access. I think this is a huge component of our work and our thinking to really help build women's resilience and then help foster greater linkages to opportunities. So we have seen that digital financial inclusion, including products such as mobile money, can give women access to a safe and private saving platform, which can alleviate some of the barriers women face when trying to accumulate savings and potentially fund their businesses. However, as you mentioned, Alberto, there are many hurdles to access. Not all women have a phone, not all women have a smartphone. So that's affordability, but it's also normative. Sometimes women are not allowed to have phones in certain communities because it's seen that they are cheating. There's a lack of education. So, okay, a woman has a phone, but she doesn't understand the power in the palm of her hands, as well as inherent biases and social, as I mentioned, social cultural norms that curtail women's and girls' ability to benefit from opportunities, offered by digital solutions. So these have implications for SDG 9, which really aims to build resilient infrastructure and promote sustainable industrialization and foster innovation. So, our position is that, savings groups can actually play a role and a key one in how women access finances and really save for a better future. But there's issues of transaction costs, fees, infrastructure, and really the sustainability of these services in reaching, and even the as you've mentioned, having this human-centered design. Is it even designed for a woman? That's the biggest challenge. They're not even designed with a woman in mind and meeting her where she is.
Thank you. So I think I'm going to hold our last question, which is really your recommendations for improvement. And we've touched on some of these until the end, and move to questions that are coming up from the audience. But I want to just comment on the points that you've both mentioned, talking about fear being a reason that women are not saving. It's not only fear of husbands, but, where are they saving? Do they actually have a secure place? In India, what we see a lot of course, is, they have gold. They have, bought a piece of gold, and that is their savings. That is completely insecure and can be stolen. And so, it's another of the behavioral pieces that disincentivizes savings. And how can we create the opportunities to easily save? And, we're making progress, but there's a lot of room there. So there's a question for Sevilla, which is about your work with WEX, and how are you thinking about scale with this model? And I'm smiling because, of course, I think that there has been some really impressive scale already, but does it work equally well across continents?
Well, first of all, it doesn't even work really well across countries. So the scale that you see in Uganda and Rwanda, for example, that has surpassed about 40% of the adult, I should say 15 to 54 age women population living under $2 a day. They are in a savings group. They are in some form of collective. But then you go to Nigeria, where about 13% of that same type of population is in a savings group. And I should say mainly rural. There's also a bit of peri-urban. We have a bit of calibrations of what we consider peri-urban as well in terms of distance from the nearest city center. So we are seeing that there's differences across countries. And then you go to Ethiopia and you only have 2% of women in a savings group, which is kind of surprising because we do hear a lot of initiative and work coming out of the savings group, but it's fairly limited in terms of the women that are involved. They're more involved in SACCOs, which is also another women's collective, or a collective that we can look at, although women's participation rates aren't as strong in SACCOs.
And so can I follow up and just say, when you say women's participation rates aren't, that means that they are more diverse, or that the SACCOs are just smaller and there aren't as many of them?
So for example, in Uganda, SACCOs, women in SACCOs present 27%. So it's you do find women in cooperatives, they're just not strong in terms of numbers, and they're definitely not in the leadership position. They're not, the chairperson or the president of that cooperative. So when we talk about scale, we have largely been looking at working with governments in order to increase the salience and appetite for governments as they're launching programs to ensure that when they're targeting women, they do so through the collective approach. Because there, as you know, I always say you can't go knocking on every woman's door with your program, with your training, with whatever implementation focus that you want to provide to the community. It's just cost efficient. It's cost inefficient. Sorry. So collectives is a platform to which governments can use to really scale up their support to women, especially in looking at driving women's economic and empowerment outcomes. We do recognize that governments will have a limited role to play. Also, there's going to be a saturation level that's reached at a certain point. The extent to which they can do, they can create the formation of groups. In Uganda, we are seeing above 40% saturation of women in groups, as I mentioned. We estimate saturation will hit around 50%. And once that saturation is hit, we are looking at aggregation models. How do we actually further aggregate these women's collectives so that there could be more enterprise growth opportunities? And then with that, you can start seeing the convergence of other market actors, private sector market actors, who are going to be able to understand how to devise products and services to reach these communities, reach these women, reach these enterprise sectors, etc. So scale is kind of a two-way approach. One, kind of the building, getting women onboarded into the groups, and then once it's reach a certain saturation level, kind of getting the market to act. Now, in saying all that, the government has a role not only in forming the groups, but also looking at the enabling environment. So looking at the policies, regulation. Again, I'm going to take Uganda as an example, where in 2015, in the Tier 4 Microfinance Act, the Ugandan government recognized these, what they're calling self-help groups. They recognize savings groups as one of the tiers of the microfinance sector that they will start not regulating, but recognizing. And so now the Uganda Microfinance Regulatory Authority has produced guidelines on how to register these savings groups in order to recognize them and to be able to define more strategic ways of working with them and working with them beyond financial inclusion efforts. So
that's an amazing indicator of just their financial power and credibility. I'd like to take this next question to Alberto, which is about engaging with communities in parallel with empowering women. How do you think about tracking and measuring that? And is there a role for cross-sector collaboration there? And I'm assuming cross-sector is what you're speaking about, Sevilla, bringing public actors into that.
Thank you, Kate. Yes, definitely. There's a lot of room for cross-sector collaboration. Sadly, it's hard. It's hard, and collaboration is it's a desired state by most of us who are in this field, but it's very hard to achieve. And there's many efforts around there, but very few actually materialize on the ground and can really go around a common objective. And governments have a big role to play, but sometimes they don't know how to do it well. Right now, for example, in Guatemala, the government is forcing this small savings group to legalize, to formalize. The only country who has done this is Honduras, and was the result of a long process, not a policy that was imposed into groups. That is something that we need to be careful about, because when we're talking about sectors approach, when we're talking about involvement of government, there might be some consequences about trying to formalize these kind of groups and impose on them restrictions to access to services from the government if they're not formalized or organized within the parameters that they establish. So I think this is one point to really consider. The other thing I will say on cross-sector collaboration is the coordination at the local level. COVID was a disaster for all, but led to an unprecedented level of giving and an unprecedented level of response and aid. And we saw amazing amount of goodness being shared, and goods and food and supplies reaching communities. That is good, but that has to stop. Those kinds of approaches hurt economic development. Those kinds of approaches hurt the processes that are starting to get in place or have been in place, and actually are setbacks for the work. Coordination is important. Having common agenda is important. The role of the government as a referee that directs and mandates some of the work, it's important. But we need to understand that this process takes time, and sometimes these band-aid approaches that we have seen through the COVID collaboration have actually done more bad than good.
Thank you, Alberto. We are at the end of our time, and actually I think that you both touched on our final question is what are your recommendations? What are ways that we can improve this? And I think that was woven through certainly your last comment. I will thank you both and say that I've learned a lot. I thought we were going to talk more about sort of formal structures and regulatory changes, and instead we talked about people. We talked about behavior. We talked about mobilizing people so that we can influence those regulations. And I think it was extremely, extremely valuable. And since the audience cannot clap for you, I will. And thank you for your time, and thank the internet where you are, Alberto, for holding on for the entire panel.
Thank you,
Thank you all.
Kate.
Pleasure being with you. Thank you so much.
Thank you for having us, and great talking with you, Alberto and Kate.
Likewise, Seville. Thank you, Kate. Thank you all.